Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about the most exciting thing since our utilities sector episode that we've ever talked about, and that is going to be annuities.
Yes, so get your pillow, get your blanket out. We're going to be putting you to sleep.
Yeah, so if you're driving while you're listening to this, you might want to either pull over or listen to it,
or if you're
later.
In a Tesla, let it do its thing.
That's right. So yes,
wait, I guess you're not supposed to fall asleep while you're in your Tesla.
Do you still have to touch
Spoiler,
the wheel? You should touch the wheel. That's how people die.
Yes.
So anyway, I hope you really don't feel that way. This is going to be an interesting discussion. But Josh, this is really all your show, so I'm going to be facilitating a discussion around your thoughts and a couple of my own about annuities in general.
Yes, and I actually do have a lot of opinions when it comes to this, but when you talk about insurance products, because that's what annuity is, we're going to get into that, but insurance products tend to be a little boring anyways.
Speak for yourself.
But I'll try to be as neutral as possible, keep my opinions until the end.
That's right.
We'll just talk about what are annuities and how do they work.
True. So let's start 50,000 foot.
Yep.
It's kind of what we always do.
Always up there.
So the official definition according to annuity.org. So that sounds reputable, right?
They got .org, so it's
I know.
a nonprofit
it's nonprofit
organization.
They're not profiting on this definition. So the definition is annuities are insurance contracts that provide a fixed income stream for a person's lifetime or a specified period of time. An annuity can be purchased with a lump sum or a series of payments and begin paying out almost immediately or at some point in the future. Annuities are often used as a way to fund retirement. So alternatively...
That's a lot of words.
That's a lot of words. To put it a little bit different, a different definition says, an annuity is a contract between you and an insurance company to cover specific goals such as principal protection, lifetime income, legacy planning, or long-term care costs. And that's from a U.S. News article, and we'll link that in the show notes below.
Principal protection, that's the guy in charge of your school. You don't want him to get hurt.
It's good insurance policy on your principal.
That's right. It's very important you do that. Yeah. According to that same article, though, by the way, annuities, or the concept of what an annuity is, has been around for a long time. In fact, in ancient Rome, people would make a single payment in turn for a lifetime of income. And
wow.
So way back in Rome, ancient Rome, were they doing this type of insurance planning? So the concept is, and if you think about it, if someone's worried about running out of money, if someone says, hey, if you give me some money now and I'll make sure you never run out of money, that's pretty cool deal.
Yeah.
So that's kind of what this is.
For sure.
So let's break it down, though. Those definitions you gave, good, but there's a lot of words in there, and there's a lot of for a lifetime or a specific amount of time.
There are options.
For a lump sum or a series of payments. Mm-hmm. You can start immediately or in the future. So let's talk about that. So, like I said, an annuity is an insurance product. It's sold by an insurance company.
Right. It's not necessarily an investment.
No.
You're not owning something.
While some invest within the product, the annuity itself is an insurance product. Yes. You actually have to be licensed by the insurance. It's a Series 7. I don't know what it is. It's a special license you need for insurance selling, an insurance license. Annuities are designed to provide a steady income stream. That's their kind of primary selling point. We'll talk about a couple that don't have that selling point, but in general, when people think annuities, they think of an income stream. And that can, like I said, either be for your life, the life of you and your spouse, or just a set period of time, depending on how you set up your annuity. You could buy one by throwing down a big chunk of money, or set it up where you pay monthly for a while, and then you stop paying and start receiving the income. So
right.
There is a lot of flexibility, and then annuity can start at any point, either immediately or in the future.
So let's kind of break down some different types of annuities. And there's going to be a lot of subcategories to that we're not even going to go into the details of, but this is like the major types of annuities here. So Josh, fixed annuity sounds like something that would be fixed, right? So explain a fixed annuity. It's not broken.
It's not broken.
If it ain't fixed, don't break it.
Yes. And so a fixed annuity...
Wait, did I say that wrong?
If it
ain't fixed, don't break it.
If it isn't broke, don't fix it. No. If it's not fixed, don't bring. I don't know.
I don't remember. Yeah. Okay. Anyway,
if it's not a fixed annuity,
Josh, what's
don't
a
buy
fixed
it.
annuity?
So a fixed annuity is fixed in the sense that there's a set interest rate that they will provide. Fixed, set.
Yep.
It's guaranteed.
It's like your mortgage.
Yep. And I use the word guaranteed a lot because you'll hear that with annuities: guaranteed income stream, guaranteed returns, guaranteed protection. The guarantee is only as good as the insurance company backing those. And so keep that in mind. But they'll push a fixed annuity and say that there's a guaranteed interest rate, which is true. They'll say, okay, you give me $100,000 and I will guarantee that from now until you start taking the money out in 30 years or whatever you set it up for, you will get a 3% return on that. It's guaranteed. And so that's what they do. They'll take your money, they'll invest it in a way where they can earn more than 3%.
Oh, yeah.
They'll grow your 3%, and then they'll pocket the rest.
That's how they make money. Exactly.
Right? That's what it's set up as. All right. So that's a fixed annuity. The other side of it, too, is because they know how much they're going to pay you in a fixed amount, they also have a guaranteed income payout for that as well. They'll say, okay, based on when you want to start this annuity, here is your guaranteed amount of income.
Right.
And then you say, okay, if I want it for my lifetime, they use an actuarial table to say, here's what we'll give you based on how long we think you'll live. If you say I want it for, so, we'll get to this because every one of these that we're talking about can either be an immediate annuity, which means it starts right away, or a deferred annuity, which means it starts in the future. So if I'm 20, I probably don't want an immediate annuity. I don't want my income stream to start at 20 because that'll be little payments.
Right.
Because my life expectancy is pretty long by the actuarial tables.
Yes.
So I might get a deferred annuity, say, okay, at 20, I'm going to start paying into it, but I don't want my income stream until I'm 60. All right, so that's deferred. If you have a fixed annuity, that deferred point, the future when it will start, they'll start your actuary from there till life expectancy or however long you want it to go. So that's how they calculate your fixed payment amount.
So
everything's guaranteed or set at the beginning point.
When you sign
There's
the
no
contract,
surprises. You know how much you're going to get, how much it's going to grow, and how much income you'll get once it starts paying out.
So there's not a lot of variables.
No, it's pretty simple. When it comes to annuities, from understanding, that one's pretty straightforward, which also means the simpler it is, the less costs there are associated with it. It's pretty straightforward. Insurance knows how much they're going to get because they really invest in pretty high, stable bonds for their own protection as well, so they just give you a little bit less than they're going to get, and everybody's happy from that standpoint.
So let's get a little bit more complicated then. So a little bit more complicated would be maybe what's called an indexed annuity. So break down an indexed annuity.
Yeah. So an indexed annuity, it's tied to some sort of index.
Ooh, like an
annuity.
S&P 500 or something?
500, the Russell 2000. You pick an index that probably have an annuity that's tied to it.
That's right.
And so what they do there is, these used to have different names to it: equity index annuity, equity variable annuity, all these different words. But an indexed annuity of some sort is designed to give you more growth potential than a fixed annuity, but they still keep in it some guarantees of downside protection. And so, again, with annuities, there's a lot of flexibility. These insurance companies can really build these however they want. So I'm going to use some examples, but it doesn't mean they have to be this way. So, for instance, you could say, okay, I'm going to buy this indexed annuity. It's indexed to the S&P 500, meaning it tracks its returns off of the S&P 500. And they may say, okay, if you give us $100,000, we will give you a guarantee from loss of 80% of that. So $80,000 is guaranteed. You'll always have that no matter what. That's the minimum. If tomorrow the market drops in half, you still have 80, even though the stock market would have gone down to 50.
Right.
All right. So that they give you a downside guarantee. And then with this index piece, instead of getting a flat 2%, 3% return, whatever they were going to give you in the fixed annuity, you get to participate in that index's growth. And the way they make money on this type of product is to offer that guaranteed downside protection. They also cap it on the upside, or they have some sort of way of capturing some performance. And so, and again, going back to the example, they may say it is a 8% cap. So if the S&P goes in a year up 6%, you get the whole 6%. If it goes up 10%, you only get 8, and they get the last 2. If it's up 20%, you get 8, and they get that 12.
Yeah.
And so they cap the top side and protect the downside so that you narrow your results, but give that downside protection.
These structured products are gaining traction in the ETF world, even outside of this.
Yeah, there are some
Very
buffered
similar.
or strategies where
Where
they
you-
kind of put that up and downside movement.
Yep, it's kind of a similar.
It's volatility reducing is what it's doing. And again,
you're paying for it on both sides.
it's an insurance company, so you're taking, and we talked about this insurance. All insurance companies do is you're passing your risk over to that company.
Yep.
So in order to pass the risk over, you have to compensate them, and that's what this structured annuities are, is that variable annuity says, or indexed annuity says, all right, if you don't want all this ups and downs, we'll take some of that up and down risk, but you're going to pay us for it. So
Absolutely.
there's a cost to it.
So you mentioned it, but we're going to hit on it now.
Yes.
Variable annuity. So not fixed. It's not indexed.
Nope.
What is a variable annuity?
Yeah, so a variable annuity, the variable piece of that word comes from your returns. Whereas the fixed annuity, you know exactly what you're going to get. In the indexed annuity, you know the range of where you're going to be. A variable annuity is you invest in a pool of investments, mutual. It looks kind of like a group of mutual funds type of thing, and you get the ups and downs of that return on whatever that grouping is. And so a variable annuity is really just a basket of investments. They don't have that downside protection necessarily, and they don't have that upside cap. There are some things you can do, and we'll talk about that in a minute, but without riders, which are add-ons, there are no protection pieces to that. So why would you not just invest in it? What is the insurance piece of that going to be? Well, all annuities are tax deferred.
Okay.
So when you have an annuity, whether you put in taxable money or IRA money, it grows without any tax until you take the money out, you pay income tax. So it works like an IRA, really, if you think about that standpoint. So if you have a bunch of taxable money, a variable annuity may be, if you're okay with the cost, may be worth that tax-deferred growth. The other piece of it, too, is there really is very little restrictions on how much you can put into an annuity. So if you think about a 401k, there's limits.
Mm-hmm.
There's an income limit. Roth IRAs, traditional IRAs, there's limits. How much you can put on and who can put them in. A variable annuity has the investment growth piece, and they really have very small restrictions on those type of things.
Right.
There's some caveats to it, but in general, you can put in about as much as you want into an annuity. So those are some of the benefits for some people say, I don't really have any other choices, and I want that tax-deferred growth. That opens up that option.
So we talked about it earlier in the definitions,
Yes.
but we had talked about one of the different options you can have when you're getting into this sort of product is you can have payouts that start today when you sign the agreement, or you can have a payout. You could sign it all now and say, I want to start it when I'm 65 or whatever that would be.
Yep.
So talk about that a little bit, maybe
And
why
that works
you would...
for all three of those,
Right.
really.
Yeah.
And the reason why you would do that is, so let's say you are a person who's worked their whole life and you're heading into retirement, and one of your biggest worries is, hey, I got all this money I've saved up. I'm afraid either I won't manage it well or I'll overspend it. I could then get an annuity, one of those three choices, probably not the variable, but one of those where I could then set up something that would guarantee that I wouldn't run out of money. It would put it in and give me a set payments for life. The deferred annuity actually is used a lot of times for people who say, you know what, one of my biggest fears are, what if I have a lot more healthcare costs when I'm older? So they may be retirement age, 60, 65, and say, I don't really need any income right now, but I'm worried that when I'm 80, I'm going to have some long-term care costs.
Yep.
Some people look at a fixed annuity or an indexed annuity as a way of putting that income piece to say, you know what, it's going to cost me about $1,000 a month for long-term care if I have to go in a nursing home or whatever. I can put an annuity that at 80, it'll start paying me that, and I'm guaranteed for the rest of my life that. So they may do something like that, push it down the road for an expense they may feel like they need in future years.
Yeah,
so that's why you defer.
Essentially saving for
Yes.
something in the future that you think you're going to have a expense for. So we also mentioned that another of the variables is that you can set the payout for a set period of time. So if you sign it today, you could say 30 years, I want payments every month or whatever, and then it'll stop. Or you can have it go throughout the rest of your life.
Yep. So an insurance contract or an annuity piece like that, which is just a set period, is the lottery is a good example. The lottery, if you win, you could choose a lump sum, or you could say, I want you to pay me increments for the next 30 years. So that's one of the choices. The lottery is an annuity option right there. And that's for somebody who says, a lot at once is not good for me. Spread that out.
Well, I bet those statistics on how bad people are when they win the lottery.
Yeah,
I bet those would go down if they would take.
If they would take that annuity, and just
because you can
stop
only
themselves
spend
from making
a little
bad
bit at a
choice.
time or whatever.
But that's just an example though of one set period of time. Now the opposite is you get it for your life or the life of you and your spouse, or you can have some of those things set up. There's a third one in there where it's a lifetime annuity with a guaranteed time frame. And so in a sense it says, well, what if I choose a lifetime, but I only live 5 years and I won't get my full amount? So you can have these set periods of time where it says, okay, I want it for my life, but if, guarantee period, maybe let's say it's 10 years. So if I die in 5, it'll continue for the next 5 years paying out to my beneficiaries until that full period is met. So in a sense, it's safeguarding the short-term risk of what if I pass away early, but also giving me that lifetime stream. So there's a lot of flexibility there depending on what you're looking at for annuities.
One of the big examples that I'm thinking about with annuities is pensions, specifically. Mm-hmm. And that is exactly how that's set up. So you have the option, just like with the lottery, right? When you retire and you have a pension. Now, pensions are phasing out. They're not so popular anymore, but this was the primary retirement vehicle for decades and decades and decades. But anyway, if you retire now, you have a pension, you're given an option. Do you want a lump sum check, Josh? Give you a lump sum check, and then you can do with it what you want, invest it, or blow it. Who knows what you want to do?
Whatever you want to do.
Or you can annuitize it.
Yep.
And you can take those periodic payments with the same options. Do you want lifetime? Do you want guaranteed spousal income should you pass? Do you want all of these different variables? And you can structure it to be an annuity.
Yep. And the other piece with all this is, again, with the flexibility of some annuities, cost of living adjustments. So inflation, the increase of cost of goods, if I get a set dollar amount, if I get $1,000 a month, well, in 20 years, $1,000 isn't going to buy me what it buys now. So some annuities have an inflation or a cost of living adjustment built in, which is a good thing. That's a positive thing, is if I get $1,000 in 20 years, I want it to be paying me, I don't know, $2,000, whatever it is, that I'm still able to buy the same amount of stuff I could today. And so that's something that a lot of pensions don't have anymore because of how expensive it is. That cost of living adjustment is a big factor. So annuities, a lot of them offer that still, or a rider you can add on to keep up with inflation.
Gotcha. All right, Josh, we're going to take a break.
Yes.
I have the dad joke of the week for you.
Joke of the week. I'm ready.
Reddit, r/dad jokes.
Yes. Hashtag.
Are you ready? Why do teenage girls walk in groups of 3, 5, and 7?
Oh, I don't know.
Because they literally can't even.
They literally can't even.
That's classic.
I love it.
That's good stuff. So, yes, annuities, that's what we're talking about. By the way, I'm going to give you props. We're going to get to it later, but I'm giving you current props on remaining quite neutral thus far.
I'm trying my best.
You're getting quite neutral. We're going to hear your actual thoughts in a little
I will
bit.
give them to you at the end.
So, Josh, before we get there,
yes,
how are annuities used?
Yes. The annuities are designed to offer some insurance against normal market movements.
Because it's an insurance product.
The insurance product, you are paying
Risk.
to remove volatility of some sort and passing that burden over to the insurance company. So they can provide against either market drops, which is that guaranteed piece on the front end, or against that fear of losing out on your money, which is that lifetime income stream. So
FOLO.
Yeah, fear of losing out.
Ooh, I just made that up. It's never been thought of before.
Never, ever. No one's ever said that. So that's kind of what an annuity is used for, is someone says, I'm just not comfortable investing and taking that full risk on my own.
Right.
I'm willing to pass that on for a price.
I would say that I think that probably sounds most attractive to someone who hasn't spent their entire working career with investments in the stock market to understand the volatility that's normal.
Yep.
So then when they think, I could lose all my money in a stock market crash, that seems awful.
Yep.
So that's kind of the way I'm thinking of it. So let's break down some pros and some cons before we give our opinions on annuities in general. So Josh, what are good things? What are things that people like to see when it comes to annuities?
Yep. So some of the things you'll hear when someone is talking positively about an annuity is they offer that security, right? The volatility security and the longevity security. They offer those protection we just talked about. Tax-deferred growth. Like I mentioned, annuities are tax-deferred. protection for your principal. Most of them do offer some sort of guarantee. Now, the variable annuity is the only one that usually doesn't or has some limited protection. Probate-free estate distribution. If you have certain riders, it's looked at. It's an insurance product, and like a lot of insurance products, that death benefit is usually bypass probate, and most of the time is not taxed, depending on how it's set up. You know, like a life insurance product. A lot of those income streams do have an inflation adjustment for them, so that's a positive compared to, like I said, a pension or a lot of those new. You know, those things are just flat set payments out. And then death benefit, like I mentioned, you can name just about anybody for that benefit. So that's another piece of passing on. If you have charitable causes, things like that, your death benefit's pretty flexible.
We are taking applications. We would love to be your death benefit. No, I'm just kidding. So flip the coin on that, Josh. Yep. There are some things that may be not so favorable about annuities, and go through those. Yeah.
So if someone's kind of against annuities, here's some of the arguments they use. Flexibility. So when it comes, I mentioned there's a lot of flexibility in making annuities.
Yeah, but once
you're in an annuity, there's less flexibility. Right. There's usually a surrender period, meaning during a period of time you're unable to surrender without a penalty. And so that locks you in. That it's usually the penalty is enough where it doesn't make sense to leave. You got to wait out that penalty period. Also, once you're in the product, you can switch from certain annuities to others, but you're kind of stuck with that insurance product and company that you're at. There is some ability to move from one another, but it can get a little tricky. The other con is it costs. Like we mentioned before, the insurance company, they're not doing this for fun. They make money on it. There are fees involved for the insurance product, and then there's also commissions, and this is a commission product in most cases. Now there are some commission-free annuities out there, but in general, most of the time there's some sort of sales cost and fees associated, annual fees that ongoing.
Right.
Complexity, we're just brushing the surface of this. I mean,
this is really high level.
In my continuing education I have to do, I mean, there's just hours and hours of education for annuities. So the complexity of these, most people do not fully understand what an annuity is when they're signing up for it. And that's
not good.
It's the scary part for a lot of times. One protection piece is because in our industry, if you are misrepresented and misinformed, there is some protection for you. So one thing you can do is if someone's talking about annuity, write down exactly how you understand it and have them sign and date it. So if there's ever an argument in the future, you can say, this is how it was explained to me and this was my understanding when I signed up.
Right.
So just something that's useful is, if they're telling you all these things like, oh, it's going to do this and it's guaranteed to do that, write that all down. Say, this is my understanding of how you explained it to me. This is what I'm going to pay, blah, blah, blah. And then have them sign and date that, and you're good in the sense of protection standpoint to say this, because it really has to do with the consumer's understanding, because investing is complex. That's part of why we're doing this podcast, is we want to help clear things up. So that's one thing you can do to protect yourself. Conservative returns, because there's an insurance piece that overlays to help provide that volatility protection, you are going to experience in the long run, historically speaking, less returns than you could get in the normal market. Because the market's up more often than it is down, because of those caps, you end up having a lower return, even with that downside protection. And then the loss of potential returns from other investments, again, one being unable to move in and out and having a limited investment choices, you just don't have flexibility, nor do you have the ability to fully capture the returns. For instance, I haven't seen an annuity you can hold individual stocks in. You have to buy within their insurance product.
The opportunity cost is huge.
Yes.
So the money that you are putting into this is money you're not putting into a traditional investment product that you could earn a higher return on. And I think another, kind of just to build on to the flexibility, liquidity is not, you have no liquidity.
Now, like a variable annuity, some of the ones you have the ability to take out even before you annuitize. Annuitize means you set up your distributions. You have the ability to withdraw certain amounts. There's usually, you can take about 10% of your overall value per year, roughly. And so there is some, but you're right, you just...
you give it up.
If you have an investment account, you could liquidate it all if you're done with it. So
even if it's a retirement account, you can liquidate it and take a penalty, but you can get to it.
Yeah.
But here your hands are tied.
Somewhat. I mean, there's that penalty involved. Mm-hmm. Yeah, it's pretty steep sometimes.
So the question is, should you invest? I'm putting quotations.
Yeah.
Is it even investing? Not really. It's an insurance product.
It's an insurance product, but they have investment pieces within a variable and index annuity.
Should you purchase or utilize an annuity for your retirement plan?
I've done a lot of talking. Why don't you go first?
Okay, so I have thoughts on this, and
I'm sure you.
And
know.
we've kind of hit on a lot of my thoughts. Yes. I really feel that based on the ultra-conservative returns, and especially if you're getting involved in periodically purchasing an annuity through your younger years even, you've missed out on a lot of returns because you're capped. You're capped on returns, even if you're in more indexed or variable type returns. They're lower than they would be should you even just go out and buy an index fund or whatever in the stock market. Because, like we've said, that insurance company, they're taking on some of that risk, and they're compensating themselves for taking on that risk in the terms of fees and a spread, usually. And I think that over time, that gap gets wider and wider because every year that gets bigger and bigger what you could get from a traditional investment product. So I think that that's something to be cautious about. I understand, the fear of volatility. However, I think what we've kind of discussed on this podcast a few times is the fear of volatility is really misunderstood. The fear of the stock market going down really isn't the issue. It's the fear of outliving your money, and you have a better chance of outliving your money doing something like this than you do if you were to invest it in stocks. Generally speaking, every situation is a little bit different, but generally speaking, you would be better off. That's my opinion.
All right, my opinion.
I said, I really feel like a lot of these are aimed at people who don't have a history of investing in the stock market. And maybe, I'm not going to say that every person who's selling this is bad or good, but they could kind of aim their targeting at these less educated of stock market experienced people, and that could be a downside.
All right. My thoughts.
You can let it all out here. You were pretty positive so far.
I was pretty neutral. So we are a fee-only advisory firm, and like I mentioned, these are commissioned in products for the most part. Now they're coming out with more and more commission-free annuities, and I've looked at those. And so if we take out that conflict of the commission piece that I have with how we run our firm for investing, the annuity products, I can see the benefit and the appeal for certain pieces and certain aspects. So for instance, and I didn't talk about this yet for this purpose, I wanted to bring it up here, is almost everybody listening right now will have, in a sense, an annuity when they claim Social Security. Oh, yeah. You've been paying in, like you do for a deferred annuity,
yep,
and then you're going to get a set income stream for life.
Yep.
It's for all intents and purposes the same definition of an annuity, right?
And how's your return been on that?
Right. And so the concept is like that's pre-built in.
Yeah.
And with that mindset, if there's somebody who says, you know what, I have accumulated more than enough for what I need, and I want to give myself a set bare minimum for the rest of my life, a fixed annuity or index annuity or something like that, where you can just say, okay, between that and Social Security, my baseline I'm covered. And then everything else is my don't worry, spend. That I could see that allowing you to be more aggressive in your investment piece because you have your baseline income covered. So I could see using those pieces, but more often than not, like you said, you could do the same thing with a bucket strategy or an approach where you put a conservative piece in that's invested in fixed income or something that's your safety net, and then the rest is vets. So there's other ways around it, but I could see that appeal is if there's a nice indexed or fixed income annuity that meets those needs and the costs are reasonable for you to justify, I could see you doing that and putting it in place to say, okay, my needs are met, everything else is the fun spending, and that I can go crazy with, and that I can invest and grow. That in the long run, you may end up with a better return than trying to really limit your volatility because you're worried about your periodic withdrawals or whatever.
Yep.
There's my thought on that piece. The other side, when you have an insurance piece added on, when it comes to those variable annuities especially, I have a hard time finding a good spot for that, because once you add in all the additional costs, you're just never going to be able to keep up with just straight an investment account. So I just don't see that appeal. The only spot would be, again, if somebody is just really trying to reduce and get that tax deferred growth, and they've maxed everything out. But again, at that point, you're probably in a high tax bracket, so I don't know really what
all right.
Yeah. And so again, I see a hard time. So, and the one that I see the concept of a fixed income stream being appealing, but there's other ways of getting there. But it's out there. There's a reason why it's been around since the ancient Roman time. Is there's a lot of people who will pay for the guarantee. And that's where the trade-off is.
Yep.
I can't tell any one person whether it's worth it or not for them. And as a fiduciary, it's always what's in their best interest. There are clients that it's in their best interest that they either keep, maintain, or go find those type of products, because for them, that fear of losing out of money,
known as
FOLO, not FOMO, fear of missing out. You're not missing anything. You're losing out.
Yep.
So that fear of losing your lifetime income or running out of money is enough where they're willing to pay the cost. And that's the thing.
Yeah.
Is that a bad product? No, for them it's not. If they're willing to, if they understand the expense and are willing to pay it for that peace of mind, then the cost is
know what
justified.
you're giving up, but if you're okay with that.
Yeah. So that's my thought. It may surprise you that I'm not so hard. I don't find a lot of annuities I'm excited about. I'm going to be honest with you, because a lot of those variable annuities are pushed because there's a lot of expenses into those things. I'm not a fan of those.
They can make good money on them.
But those index annuities, if you look at it in a sense, index annuities have that guaranteed downside and then a cap. If you supplement a fixed income piece with that, I mean,
you pretty much
if you net the same, then you net the same, and you just have it in a different structure.
And you pay less fees.
Tax deferred.
Right.
It's just, again, I could see it. Do I like it? No. Do I think there's other ways of doing it? Yeah. But, if someone goes that route, that's fine. If you buy an S&P index annuity with a guaranteed 3% return and then a 7% buffer, well, you're going to get fixed income between 3 and 7. I mean, that's the way of looking at it, right? So, I could see those playing out, that if your net is there and you're saying, well, that's what I was going to be doing over here anyways, fine, whatever, go that route. But then understand you got your, surrender period and all that stuff, that if your mind changes in 7 years, you may still not be able to do anything.
Potential liquidity issues,
So I see the concepts being a fee-only advisor. They're just limited to what I think makes the most sense. But they're out there, and there's a reason why it's popular. There's a lot of people that sell them, a lot of people that I've run into that actually like what they're getting from some of those products. They say, you know what, I know I'm paying 3% a year, but I don't have to worry about it. Okay, if you understand the trade-off, then for you, all right, go for it. So that's where I'm at.
Well, Josh, this is good stuff.
Good stuff. I bet everybody loved
this is the best episode
Annuities
ever.
It's awesome.
It was a variable length episode. We'll see about that. I don't know when we're going to cut it. So anyway, 2 things. Number 1, it is not too late to enter our second half stock draft competition. It is almost halfway through the second half, and Josh is still in it.
I'm still in almost last place.
But you would start with a fresh 100,000 for the last quarter, and the last quarter is typically pretty good for the market. So
create a new alias and start over.
Exactly. So it's not too late. Check that out. There's details on our website or our social media on how to enter there. Number 2, as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. Generally speaking, we don't talk much about annuities because it's not our preferred often product.
Right.
So there we are. Check it out. It's free on our website. Josh, how can people help us grow this podcast?
Yeah, make sure you subscribe. That way you get our podcast every Thursday when it drops.
Even every Thursday, ever.
Every Thursday.
Ever. We haven't missed one yet.
It's the insurance annuity of the podcast world. Guaranteed.
Keeps coming.
It's always going to be there as long as we're still around. All right. That's the insurance company, right?
Thank
as long
you.
as you're still in business.
Actuarial table discussion.
Yes, right. Subscribe, but leave us a review on Apple Podcasts. If you have any questions about annuities or anything like that, or have a topic you'd love for us to talk about, even if it's as boring as annuities, we would love to talk about it. Shoot us an email at hello@theinvesteddads.com. And if you like this, I know everybody's going to like this episode, but if you really like this episode, share it with your friends.
Wake up and push the share button.
Yes, that's right.
All right, well, until next Thursday, have a great week.
All right, talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.